good things happen, but you were explaining why now is the time to be sort of risk off or a little more cautious.
I think you want to be cautious, right? I mean, I think you look at the world and you say, what do we know? We know that you are at the end of a 10-year expansion, what we would call a miraculous recovery from the low of 2008. You know you have a trade war with China with many possible outcomes, but very little degree of certainty. You have a tough situation in the Middle East. You have uncertainty about Brexit and I would say Italy. And so you want to be cautious. And I think one of the themes is that you don't want to be always full on in terms of risk. And so right now we're cautious from a macro standpoint.
What does that mean? Keep buying treasuries, the dollar?
Thinking about the risk you have on, thinking about the downside, thinking about what you will need to do in terms of trading out of bad risk, thinking about the liquidity of your portfolio, thinking about what may go wrong, and thinking about scenarios where you want to be able to add on weaknesses in certain assets if the time comes. And I think you always want to benefit from market downturn and be able to add.
So do you just shorten durations and focus in on particular asset classes?
To some extent, yes. I think we have no strong view in terms of duration in the U.S. right now. But I think we have non-agency mortgages. I think we have mortgages that we like. I think we like some credit. I think we like UK banks. I think we have a broad portfolio of securities that we like and we think are, bulletproof for most environments.
Do you think that Jay Powell can do as he promised, act as appropriate to sustain the expansion and keep it going in the United States?
Yes, we do. There's a lot of things which are out of his control, and I think one of the complexity of the Fed's job is to deal with what is not an easy political situation where his reading is not better than any of us in terms of what may or may not happen in the months to come and whether we get a resolution in 2019 or not to the situation with China.
Manny, are you concerned at all about this recent tumult in the repo market? Is it something that you guys at Pimco are aware of, watching closely and wondering about?
We are very focused on it, as you would expect us to be, because we are the largest bond manager in the world, and so yes, we do.
Yes, I would expect so.
We think it's a technical problem, and we think that you had a confluence of events with taxes happening early this week, and we think that the Fed is all over this.
You do. I mean, they intervened for the third day today, but you think it's technical, not a sign of something beyond that.
No, and it's different from 2008, and I think we shouldn't overread into technical situation what, more than a technical problems.
Do you think we could ever see negative interest rates in the U.S.?
I would say very unlikely. It's of course possible, but the U.S. economy is not in recession. Our base case, as we were talking earlier, Sarah, is that the U.S. will slow down to 1%, but we don't foresee a recession, and accordingly, there's absolutely no reason why rates should be negative.
I mean, there's not necessarily a recession in some countries where there are negative rates. Is that the main reason?
Well, I think if you look at where you have negative rates, there's two reasons, right? One, that they have no growth for the better part of the past 10 years, and two, that the central bank has been buying every possible bonds they can. And if you think of the mission of the ECB, they really have reinsured the weaker credit. That's the way, as a European, I think of it. The ECB has basically got Germany to guarantee Italy and Spain. And the result is obviously this very strange situation that none of us have ever seen of $17 trillion of bonds with negative yield.
How close is Europe to a recession, and do you foresee one in the near term?
They are not far away, and obviously Germany, for example, is very exposed to the China and the export sector, and that's
getting a lot better.
Yeah, that can tip. But France has done better than expected, for example, which is surprising. And then, the UK, who knows what's going to happen with Brexit over the next 2 months?